Okay, awesome. Hi, everyone. Thank you all for joining us today for today's Young Not Broke live event on First Job Finances. We are extremely honored by the interest and turnout today, given everything that's going on. I would like to take this moment to share that Young Not Broke stands in solidarity with the Black Lives Matter movement, and that the entire team and I are taking this time to learn and educate ourselves and those around us. So personal finance is tied directly to economic justice, and then which is tied directly to racial justice. So there are numerous studies that actually show that there is not only a wealth gap between Blacks and whites, but also that Black people are kind of behind white people in terms of knowledge of personal finance. There are many reasons for this gap in knowledge, but one of them is purely access. So, and the connection between financial literacy and financial wellness is well known, and this ties directly to the mission of Young Not Broke, which is really to empower young people to take control of their finances. We believe that personal finance can be empowering, but putting your money to work to empower those around you is even more powerful. Maggie will also be sharing a few resources in our presentation today as well. With that being said, I would like to introduce today's event and our speaker, Maggie Johndrow. Young Not Broke was started a few months ago with the goal to kind of really share personal finance stories and get that conversation around personal finance started. So we were sharing relatable like stories about young professionals and recent graduates and kind of what they were doing with their money on a day-to-day in a newsletter. From that newsletter community has now grown to over 850 people strong. So that's something we're very, very proud of. We've expanded by also breaking down personal finance concepts. And recently we launched this series of live events. Today's live event will touch on kind of some of the personal financial decisions you should be making when you start your first job. So this is everything from 401ks, HSA and FSA accounts, stock options, equity, and lots more, and kind of really how to make the most of them and set up those systems for yourself for success. So today's wonderful speaker is Maggie Johndrow of Johndrow Wealth, where she primarily works with women and millennials on their personal finances. She's also launched this wonderful initiative called the Next Gen subscription service to provide accessible financial planning advice for young people. So for today's event, Maggie will be going through a presentation for, I would say, the first half of today's time, and then we'll be taking your questions at the end. But feel free to put your questions throughout the event in the chat box. Christina and Daniel, who are on Team Young Not Broke, will be kind of moderating the chat, and we'll be kind of collecting all your questions, and then we'll be going through them at the end of the presentation. So without further ado, I'd like to hand it off to Maggie to kick off today's talk.
Hi everyone, I'm Maggie Johndrow. Thank you, Kavya, for the wonderful introduction and for having me be here. And thank you to the Young Not Broke team as well. So I'm going to share my presentation now, so just bear with me. Okay, so your first job and finances, what should you be doing? I first just want to further introduce myself, though that was a wonderful introduction. My name is Maggie Johndrow, and my information is on the screen. I do ask everyone to follow me on social media. If possible, if you do one thing for me today, I would really appreciate that. You can see the handles right on the screen. My information will also flash at the end of the presentation, and I'm sure Young Not Broke will also send out my information. I am happy to answer all your questions that don't get answered today, or if there's something very specific that you have a question on, feel free to email me. As mentioned, it is a life passion of mine to provide financial literacy to those that don't have it as accessible. I started my career on Wall Street after graduating with my master's degree from the London School of Economics. So I'm aware that I've had a lot of privilege in being able to gain financial access. But interestingly enough, my parents are immigrants to this country. So they did not teach that to me. And I kind of learned it through some of the institutions that were available to me. So again, I have a big passion to provide financial literacy to those that don't have access to it. And that, of course, includes Black people and people of color. And so I'd be remiss if I didn't talk about the disparity between wealth when it comes between Black and white people. A few statistics from the Global Financial Literacy Excellence Institute is that, one of the reasons that there is a disparity between Black and white people when it comes to personal finance is because of accessibility, as Kavya mentioned. They did a study that found that only 38% of African Americans answered their personal finance or PFIN questions correctly, whereas 55% of white people did. And they found that Black people actually were their highest literacy rate was in that of borrowing and debt management, whereas their lowest literacy rate was in comprehending risk, investing, and identifying resources to grow their personal wealth. So even those questions that they did got right tended to have to do with debt, and the ones that they got wrong had to do with ways to build wealth, which is investing and risk management and insurance. There's a lot of reasons for this: housing segregation, Jim Crow policies, voting policies. So I want to at least address that our industry has to do better. We do not have enough women. We do not have enough people of color in this industry. If you want to learn how to get into personal finance and being a financial advisor, please email me. I'm also very empathetic to you all graduating into a recession, because I too graduated into the 2008 recession. So I'm always here to share my own story. So before going into the meat of the presentation, I did want to share a few things. First, this is a list of Black personal finance people to follow. The first one is actually a dear friend of mine that I met at another event that I was a speaker at. Her name is Carmen, and that's Make Real Sense. But the others are all really great people as well to follow for personal finance. And again, they're all people of color in this industry. Next, if you want to read some books, I've also positioned those on the screen. And these are all really great books to understand why there is this gap in wealth, literacy, financial literacy, and wealth in general between Black and white people. So, all right, on to the actual presentation. So this is your first job checklist. We're not going to go through everything today, but I wanted to provide the checklist so that you make sure you do all these things when you start your first job. So it might seem silly, but opening a bank account is important, but also that bank account, check the underlying provisions of that bank account. Is it FDIC insured? Do you have overdraft protection? Is there an account minimum, or is there a fee associated with the account? There are plenty of bank accounts out there that are free. And so as a young person, every penny is counting. And so make sure that you're opening bank accounts without additional fees. Set up direct deposit with your first employer. Again, this is pretty standard practice now, but that should be a free service provided to you by your employer. And that's going to be crucial as we talk about automating your savings. Create a budget. It's not no surprise that a budget's going to be the pillar of your financial success. Understanding what your absolute expenses, necessary expenses are versus what your wants are. And be wary of keeping up with the Joneses. It's going to be really enticing when you get that first paycheck in your new job to go and spend it on a luxury item. That's not to say that you can't work that into your budget, but don't let that blow your budget. Paying yourself first, so automating your savings. We'll certainly talk about that throughout today's presentation. Applying for your credit card and building your credit score. Again, that could be its own presentation on its own. If you have any questions about building your credit score, email me separately. Saving for retirement. As Kavya mentioned, that is going to be the bulk of the presentation. Understanding your employee benefits like HSAs, FSAs, employee stock options. Paying down and refinancing debt, and coming up with a student loan payment strategy. Again, happy to answer those questions offline for you if they're applicable. And then, of course, get professional help as needed. So I already mentioned these are the three major pillars that we're going to talk about today. So first, automating your savings. You want to pay yourself first. What does this mean? This means that when the money hits your account, you need to be able to automatically have it flow into other accounts. Do not keep all of your money from your first paycheck in your checking account. You want to set up short-term, intermediate, and long-term, which really is retirement savings. So let's talk about immediate expenses. That is the only number that you should be keeping in your checking account. That money should be to cover your weekly or monthly bills and any sort of kind of fun additional activities you're doing, like going out to eat. But you shouldn't be keeping your majority of your savings in your checking account because you're going to be enticed to spend it. Next, you should try to create a 3 to 6 months worth of living expense emergency fund. This is money that is kept in cash. This is not invested. And the reason being is that if God forbid something happened, if you lost your job, you could still maintain your current living lifestyle for 3 to 6 months as you seek a new job. I would suggest considering a high yield savings account. And I listed 3 popular ones amongst my clients: Ally, Capital One 360, and Marcus by Goldman Sachs. To give you perspective, these give you a higher interest rate than your traditional banks, such as Bank of America or Chase. There's many reasons for that I'm not going to get into today. I'm happy to talk about it offline, but the difference is substantial. Right now, the average high yield savings account is returning per year, the yield is 1.4%, whereas the average interest on a traditional savings account is 0.01%. So on a savings of $1,000, we're looking at a difference of $140 a year of interest versus 10 cents of interest a year. So as you can see, as those numbers grow, it could be pretty substantial. Next, you want to set up your intermediate fund as well. Now, this comes next chronologically, perhaps, because retirement is long-term, but I would say before you start investing for the intermediate term, you want to set up that retirement account. But I did have to include this because I want everyone to know that you can start investing even before you have a substantial amount of wealth built. There are great robo-advisor tools out there, such as Ellevest or Betterment, that are really great ways to get started. I encourage your timeline to be 5 or 10 or more years, but this is money that you can access after it's grown before retirement. So maybe it's to purchase property, for example. And last, and again, the bulk of the presentation, we'll be talking about long-term retirement, which of course is hopefully greater than 10 years for most of you, or maybe not, maybe you want to retire early. Some of the accounts that you can have access to are 401k, 403b, 457, IRAs, and Roths. Again, we'll talk about many of these in depth, but I want to quickly talk about the differences right now. So a 401k, you'll likely see if you're working for a corporation. A 403b, you're likely to see if you're working for a nonprofit or maybe a local state entity. And a 457 plan is typically for government employees. From your perspective as the investor and as the employee, they pretty much are the same. They have the same limits, they have the same provisions around them. They are really named after the IRS tax codes, so that's where the names come from. And the names are really indicators for the IRS as to how that employer can get different tax provisions. So again, for your perspective, I kind of can treat them the same way. There is an additional provision with the 457 plan. So if that applies to you, feel free to chat with me offline. It's just an added benefit if you are a 457 employee. An IRA, anybody can open up. That stands for Individual Retirement Account. And as long as you have earned income on your W-2, you can open up an IRA. The major difference between an IRA and a 401k is the limit. So a 401k, you can put up to $19,500 a year if you're under the age of 50 into those accounts. Whereas an IRA, you're capped at $6,000. There's also an income limitation for an IRA. So if you make above a certain amount, you're not going to be able to deduct your contributions on your taxes into the IRA. Whereas with the 401k, you do not have that income limitation. And last, you might be seeing when you have your first job, a Roth 401k or a Roth 403b. You also can open up a Roth IRA, and the difference is when you pay your taxes. And again, we'll go through that later in the presentation. So I have to bring up Social Security because a lot of people falsely believe that Social Security is enough for retirement. You may not know, but Social Security began in the 1930s as part of FDR's New Deal. It was truly meant to just cover the basics and never meant to completely supplement retirement savings. And payments would start for people at age 65. However, at the time, the average life expectancy for a woman was 62 years old, and for a man was 58 years old. So Social Security, frankly, was never intended to last more than a couple of years for people. And frankly, some employees never even got to use Social Security because they didn't reach 65. They passed away before then. So today, the average life expectancy is for both men and women in the mid 80s. So if we're retiring at 65 and we're expected to live until 85, we need 20 years of retirement savings in order to be able to sustain ourselves. Social Security was never meant to do that, and you can see why it's such a drain on the system. So how does this tie into paying yourself first? Well, this is really where the 401k comes into play. It's important to note that 401k plans are not necessarily difficult, but they don't run on autopilot. They do take oversight, and whether that comes from you or paying someone to oversee it. And even if you decide to pay someone to oversee it, you still should have a basic understanding so you can make an informed decision about who you're going to pay. So we need to think about not only when are we retiring, so the year, but also how much may we need in retirement. This mathematical example on the screen is very basic, but it's a great place to start. So let's say that you feel that right now you're making $50,000 a year and you're pretty comfortable making that amount, right? You're making your basic living expenses and you tell yourself, you know what, if this is all I make for the rest of my life, I'm going to be all right. So we typically think, financial advisors typically believe that you're going to need about 85% of your current income to continue to live the lifestyle you want in retirement. So in this example, we took 50,000 and multiplied it by 0.85. You can do that with your current salary and do the same thing. And then we get the number 42,500, and that is the income we're going to need every single year in retirement. So again, if we retire at 65 and we live until 85, that's 20 years that we need to have $42,500 a year. So simple math tells us we're going to need about $850,000 saved for retirement. Now, this is not even including inflation, which we'll talk about later in this presentation, and also not including any healthcare costs, which of course, as we age and live longer, continue to be more expensive. So this is a good place to start, but the number you're going to need is actually probably going to be higher than this. This number is obviously really daunting for all of us as we start our careers. But you'll notice over the next few slides that the sooner you start, the earlier you start, the better. So the potential benefits of a 401k are a few. One, it can actually be really easy and convenient. It doesn't really take a lot of effort. You decide how much you want to contribute. You can either say a dollar amount or a percentage amount when you start your new job, and your employer is going to automatically deduct it from your paycheck and put it into the account for you. In 2020, as I already mentioned, the limit that you can save per year is $19,500. If you are over the age of 50, which I assume many or most people on this are not, but just so you know, there is a catch-up provision, so you can actually add $6,500 on top of that $19,500. And you get to decide how you invest that money in the plan. You certainly can use the default that the plan offers you, but you also should make an informed decision if that's right for you. And again, we'll talk about that in a bit. Another really important part about a 401k, which by the way, I'm using interchangeably with 403b or 457, is there an employer match? So many employers will say, if you put in 3%, we'll also put in 3%. Guys, this is free money. Do not leave this money on the table. Put in another way, if your employer said to you, hey, I'm going to give you an additional $5,000 this year, wouldn't you say, of course, I want it? You know, what's the catch? There is no catch other than you have to do the work yourself. So if you put in 3% for the year, your employer might match the same, and don't put in less than that or zero, because you're literally leaving free money on the table. The other benefit of a 401k, if it's not a Roth, is that your money is going into the 401k pre-tax. So this means the money goes in there without paying any applicable federal or state income taxes. So this can actually be substantial for people. let's say for easy numbers, you make $100,000 a year. I'm going to round up the max that we can put in per year from 19,500 to 20,000 just for easy numbers. So let's say you put in, you make $100,000 a year and you max and put in $20,000 into your 401k. You are only going to be taxed on $80,000, 100 minus 20, right? $80,000. This, if you are in the 22% tax bracket, for example, not only have you just saved $20,000 this year, but also you've saved about $5,000 in taxes simply by doing that. It might even put you into another tax bracket. Maybe you'll go from a 22% tax bracket to 20% tax bracket, which would result in even more substantial savings. If you have any questions about the taxes when it comes to 401k, a CPA is going to be your best bet to talk to. Another major benefit of a 401k is that it's disciplined savings. This might be one of the biggest benefits of all, because again, that money is going directly into your 401k without ever hitting your checking account. You're going to get used to not seeing that money, and you're not even going to feel the difference of that not being in your checking account. And lastly, a pre-tax 401k, so again, a non-Roth 401k, your earnings from your growth and of your investments are going to grow tax deferred. So you're not going to have to owe taxes on them for the 40 years that you're saving your 401k. You pay your taxes once you take that money out in retirement. And for many, that means that in retirement, they're in a lower tax bracket than while they're working. So again, going back to that $850,000 number, that might seem really scary, but I'm going to show you the advantages of saving early when you're young. So Susan starts investing when she's 30. And she just invests for 10 years. She doesn't put in a dime into her 401k after she turns 40. We're going to assume a 7% annual rate of return. And by the time Susan is 65, that $40,000 that she put in will, at a 7% annual rate of return, will give her $343,000 saved. Now, you might think 40,000, well, that's a lot, but remember, it's over the course of 10 years. So that actually is only about $333 a month. By the contrast, we're going to have Joseph. Joseph starts later. He starts saving when he's 40. He continues to save 2.5 times longer than Susan did. Remember, Susan just saved for 10 years. Joe saves from when he's 40 years old to when he's 65 and he retires. He's put in $104,000 himself. Remember, Susan only put in $40,000. We also are assuming for Joe a 7% annual rate of return. At 65, Joe is going to have $294,000. So even though he put in 2.5 times more than Susan, because he started later, he still ends up with less than Susan. So hopefully this drives the fact that in your first job, there's probably nothing better you can do than start putting away money into your 401k, even if it's a little bit amount. You might have heard of the rule of 72. That's another really great way of kind of driving investments home. Basically, the rule of 72 tells you how long the number of years it's going to take for you to double your investment. So you take your expected rate of return. So in our example, we're going to use 8%. We divide that 8% into the number 72, and the result is 9. So for this example, it would take the investor earning an 8% rate of return 9 years for their money to double. So for this reason, it's really important to pay attention to what is your expected rate of return and what are you investing in? Stocks, bonds, a combination. That's going to dictate your rate of return over time. So I kept referring to a Roth, and so you can see that's what our next topic is. So a traditional 401k, contributions to it are made before taxes. And then when you withdraw that money out of your account, it is taxable. A Roth contribution are made on an after-tax basis. So if you think back to my example when I said, okay, you make $100,000 a year, you put $20,000 into a 401k, and now you're only taxed on $80,000. In this case, that's not true. If you're putting into a Roth 401k, you will be taxed on all of that money. But the benefit is that qualified distributions, when you start taking the money out in retirement, are tax-free. One thing to note is if you take the money out before you are 59 and a half, whether that's in a Roth or a traditional 401k or IRA, you will be penalized 10% and you will have to pay taxes in the traditional 401k. So that's something to think about. This money is really money that's meant to be for retirement. I encourage you not to take the money out before you're 59 and a half years old. There are some nuances in a Roth 401k, and there are some exceptions for an IRA or 401k. For example, if you're buying your first home, you could take out the money without the 10% penalty, or if you suffer a disability. But for our purposes today, I'm not going to go through those. But if you're interested in them, feel free to email me and I'll send you some resources. So who might benefit from a Roth? First, employees who expect to be in a higher tax bracket than they are today or when they retire. So I always think about, the greatest example I give is the resident doctor. So on average, a doctor in residency makes about $50,000 to $60,000 a year in the United States. That doctor, quickly after they finish residency, starts making typically six figures on average. And so a doctor in residency really should consider putting money into a Roth, because during those years in residency, they're probably in the lowest tax bracket that they're ever going to be in. That's also pretty true of people who start a new job. You know, this is your first job and it's probably the lowest amount you're ever going to earn, I hope for your sake, and it's only going to grow. So for the first few years of your new job, it might be beneficial for you to put money into a Roth, especially if you consider your income to grow in the future. Again, that brings me to my next point. Younger employees like yourselves with more time until retirement to accumulate tax-free earnings are great candidates for Roth contributions. Furthermore, if you have a Roth 401k and you're a highly compensated employee, that might be something you want to take advantage of, because a Roth IRA actually has an income cap. So if you make above a certain amount of money, you cannot open a Roth IRA. That is not true of a Roth 401k. So if your employer offers that, it's also a great idea to take advantage of that. And then of course, employees who might want to leave their tax-free money to their heirs. Again, probably something you're not thinking about now, but something good to remember in the future. So I always get the question, which one should I do? You can do both. The $19,500 limit is for both types of accounts, but many employers do offer both a traditional 401k and also a Roth 401k. So there's nothing to say that you can't contribute to both. Another thing that I would highly suggest you do when you set up your 401k as a new employee is to increase the amount by 1%. Many plans have an auto escalate feature, which says every single year, how much do you want to increase the percentage that you're contributing? So again, going back to our friends Susan and Joe, in this example, each of them are 45 years old and they each have an annual salary of $40,000. They each start with an account balance of $50,000 and their investments are earning 7%. And of course, it's compounding monthly. They both contribute to the plan starting at 3% of their pay. But Susan elects to increase her auto increase by 1% each year for 10 years, so that she's contributing 13% by the time she reaches 55. And she continues saving at that rate until she's 65. So look what happens. Joe stayed at that 3%, while Susan increased incrementally by 1% each year. Again, Susan comes out on top with $358,000 saved, whereas Joe has $254,000. So if there's anything you can do is increase it by 1%. I promise you will not miss it in your paycheck. And hopefully your wages are growing a little bit faster through raises or bonuses than 1%. So then you truly, really don't feel it. So that's 401ks in a nutshell. But let's talk about investing 101 because you do need to invest as part of your 401k. So the first thing I do is start with the basics. Stocks versus bonds. Stocks you own, whereas bonds you loan. It's my little nursery rhyme, easy way to remember it. And so if you own a stock, what that means is that you actually own a piece of the company. So every stock that you purchase or every share that you purchase is a vote. So that actually means if you own 51% of the outstanding shares that are available of a company, you actually get 51% of the votes, which we all know is the majority. And so you basically have control of the board of the company. Needless to say, it's pretty impossible to do that unless you're an executive of a company. But my point is that these stocks do have value, right? They're votes for the company. And yeah, you get to vote. Truly, you'll get things in the mail or email when it's time to vote for new board members. What this means is that you reap the benefits of the company doing well, but that also means that you suffer the losses of the company not doing well or going into bankruptcy. A bond is basically a loan, but it's a loan that the corporation or the government is taking from you, the investor. So my favorite example is a government, and let's say that they are building a new stadium. Let's say the Yankee Stadium in New York needs to be rebuilt. They might ask investors for a loan for that stadium, and they're going to issue a bond. That bond is essentially a contract, and it says, all right, Maggie, you gave me $10,000. I'm going to repay it to you in 10 years, and I'm going to give you 3% interest for the fact that we're holding on to your money. So stocks generally have a higher risk. Why? Because as I mentioned, you own a part of the company. So if the company goes under, you're a part owner and you just lose your investment there. The S&P 500, which is one of the many indexes we use to measure the performance of stocks, has returned approximately 9.5% since 1928. Bonds, on the other hand, are generally lower risk, and the reason being, especially if it's a government bond or a Treasury T-bill bond, for example, which are issued by the federal government, fact of the matter is governments can always tax their citizens to be able to repay their bondholders. Obviously, corporations can't do that. So there's lower risk of default there. But because there's lower risk, there also tends to be a lower reward. And so you'll see the 3-month T-bill average return since 1928 is 3.4%. So what's right for you, right? You have this new job, you're already trying to understand, how to maneuver in this job, and now you have to think about whether you buy stocks or bonds in your 401k, right? So instead, I encourage you, especially if you're a novice investor, to buy a mutual fund or an ETF. A mutual fund is a basket of investments, and it's managed by a professional called a portfolio manager. So you're going to purchase this basket, and within it, you're going to see a lot of different holdings, a lot of different companies, maybe a lot of different bonds. The beauty of this is, one, you can set it and forget it because the portfolio manager is doing the work for you and choosing the underlying companies. And two, you're also diversifying, which is one of the best ways to reduce risk. And I'll show you why. Let's say you put all your eggs in one basket, so to speak. I'm using a pun, forgive me. So you put all your eggs in one basket, and that basket is Apple. And let's say you've put 100% in there and Apple goes bankrupt tomorrow. You now have $0. You also have gone bankrupt with Apple. If you've bought this mutual fund, which has these 4 companies in them, and Amazon goes bankrupt tomorrow, well, now you've only lost 1/4 of your money because Google, Netflix, and Apple are still thriving. And the beauty of a mutual fund is they can have as little as 100 names, but they can have as many as thousands of names. So think about it. One of those companies goes under, well, you've only lost 1/1000th of the money you've invested. ETFs always come up with this question. So a lot of 401k plans don't have ETFs available, which is why I don't have a slide on it. But an ETF, in case you don't know, is an exchange traded fund, and it does not have a portfolio manager managing it. It's basically just buying the stock market itself. So you might buy an S&P 500 ETF, And that means you're going to be invested in the 500 companies found in that index. The reason they're enticing is because they're really cheap, because you don't have a portfolio manager managing the portfolio, right? Because you're paying someone to manage. That being said, in most 401k plans, those costs either are covered by your employer or they've been negotiated to be a lowered rate. So do be mindful of costs of different funds, but don't not invest in one of them because of the cost. Sometimes the cost is worth it, right? If the fund's done really well and it has a great portfolio manager, it's worth it. So another way to make it simple in your 401k is to use a target date fund. Essentially, you find the year you're going to retire, let's say it's 2040, and you're going to choose the fund that has that year in its name. Again, a portfolio manager is going to manage it appropriately. So probably when you're young, it will be very aggressive. And as you get closer to retirement, it will be more conservative. Again, it's a really easy set it and forget it function. The other option you might have is a managed account. So it might say, for example, Fidelity Conservative Growth Fund, Fidelity Aggressive Value Fund, right? That is saying aggressive is meaning that you are willing to take on more risk with the hope of more long-term reward. And conservative is saying, I want to give up some of the reward during the good years to manage my downside when the market goes down. So if you are an investor right now and you saw the recent recession we saw in the market in March and that made you incredibly uncomfortable, well then maybe you should be in a moderate or conservative portfolio. If it didn't faze you because you know that you have 20 years of investing ahead of you, well then maybe you should be an aggressive portfolio. This is what we call risk tolerance, and everyone's risk tolerance is really different. If you're not sure what yours is, feel free to email me. We have a really neat online interactive software tool that you can use to determine what is your risk tolerance. And I always offer that free of charge. So why are we investing our money in our 401k as opposed to just putting it under a mattress or in a traditional bank account? Or you mentioned that high yield savings account, Maggie, isn't 1.4% enough? The short answer is no, and it's because of inflation. So inflation is the cost of goods and services getting more expensive over time. And it's also the decrease of the power that your money has to purchase those goods and services. Inflation has averaged over the last 50 years between 2.5% and 3%. My favorite example is the example of a single serving of Coca-Cola. In the 1960s, a bottle of Coca-Cola, because they didn't use cans then, was about 5 cents. Today, a can of Coca-Cola from the vending machine is about $1.50 to $2. Today, you cannot buy anything with a nickel. You can't even buy a stick of gum. So a nickel or 5 cents on its own is essentially worthless in today's society. So it's not out of the realm of expectations that $1.50 in another 40 or 50 years is going to be worthless on its own as well. And it's also not out of the realm of possibility that that can of Coca-Cola is going to cost you $5 in 40 years. And so why is this important for long-term planning? It's because our money needs to grow faster than inflation. So if you think back to my stock versus bond slide, bonds, even though they take on less risk, on average since 1928, only returned about 3.4%. And if inflation is hovering between 2.5% and 3%, you're barely growing your money past inflation. It's going to lose its purchasing power in the future, which is why a healthy mix of stocks and bonds is very important for long-term savings versus just putting it into that high yield savings account, which again, today is about 1.4%, which is well below inflation. The biggest reason people don't want to invest is because they're really afraid of losing money in the stock market. So this is one of my favorite slides, which shows Time magazine covers of atrocious events that occurred all throughout history. It starts with the Great Depression, goes through various wars, includes political events like Nixon's impeachment, and ends with the recent 2008 recession. I'm going to have to update the slide after this past March. The black line is the Dow Jones Industrial Average, which is another way that we measure the market. And if I were to zoom in on the black line at any one of these covers, these Time magazine covers, it wouldn't look good. You would definitely see a decrease in the market. But looking at it zoomed out, you can see that the trend over the course of decades, while bumpy, is upwards. And that is a reasonable assumption that over time, we do expect the market to continue to trend upwards. Sure, there are reasons that it might not, but I think if that were to happen, we would have far greater problems on our hands than just thinking about our retirement. And in the purple bubble, you can see that a question: in any 10-year investing period, what is the probability that that stock has a negative absolute return? So what that means is I zoomed in on any 10 years, it doesn't even have to be consecutive, right? In any 10-year investing period, the probability that there would be an absolute negative return for those 10 years is 1%. Flipped, that means that any 10-year investing period has a 99% chance of being positive. So yes, it's scary in the short term to see the volatility that we experienced this past March. But again, have faith that in the long term, this is still going to outpace inflation and allow you to have a more successful retirement. So the last section that we're going to go on to is employee benefits. Again, one of your employee benefits is certainly the 401k, which is why we spent so much time on it. You also are going to want to think about your healthcare benefits, life insurance, disability insurance. Those are things I haven't, for the sake of time, added here, but a quick note on life or disability insurance. The questions you're going to want to ask are, one, is that portable? So if I leave this job, will that disability or life insurance follow me to the next job, or do I have to remain employed here? Fact of the matter is millennials and generations following are job jumpers. That's the way we make more money and get promotions. So you don't want to be paying excessively into something that you're not going to be able to bring with you. So that's something to think about. If it is portable, then you should really think about getting life or disability insurance when you're young, because primarily it's based on your health and your age. So the healthier you are and the younger you are, the better rate you're going to get for that. All right, so first we'll start with FSAs versus HSAs. This is from a website called napkinfinance.com. I highly suggest you all check them out. This is exactly what they do. It's an artist and they draw on a napkin, and they're really easy to understand financial, personal finance tidbits. So an FSA is called a flexible savings account. And basically the money is taken directly from your paycheck, just like your 401k, put into an FSA pre-tax. So again, it's a great way to save on your taxes. Your company also might contribute, which is also a really great added benefit. So check if they're contributing, because again, that's free money that you're leaving on your table. The HSA is a health savings account. So again, money is going in from your paycheck pre-tax, and also your company may match your contribution. The major difference between the two is the FSA is employer owned and the HSA is employee, or you own it. So this means if you leave your current job, an HSA will follow you, but an FSA will not. So something to consider. Also, most people, if an FSA is offered, are eligible. An HSA, you're only eligible if you choose the high deductible health insurance plan. Now, I'm not a health insurance expert, but I can say that most employers, most big corporations are going to offer you a few different options. And usually you get a PPO plan, which is a low deductible plan, and you get a high deductible plan. Again, you're going to have to look at your personal situation to understand what's right for you. But generally speaking, if you're a person that only sees your doctor once a year for a checkup, a high deductible plan might make sense for you. And in that case, you'll be able to take advantage of the HSA. If you see a doctor very regularly, then you'll have to do the math and the break even on that to see if it makes sense to have a high deductible plan or pay more every single month and have a lower deductible. So both of these accounts can be used for copays, deductibles, medication that you're taking, physical therapy, glasses and contacts, and orthodontics. The big difference is that if you don't use your FSA money by the end of the year, you're going to lose it. So personally, I've been guilty of this, and my husband and I are scrambling to buy contacts and like prescription sunglasses at the end of every year. So you want to just make sure that what you put into your FSA, you know you're definitely going to use that year. An HSA, the money does stay in the account and rolls over year to year. And actually, an HSA is also invested. So that money can really grow. It has earned itself the nickname, basically a retirement account for, or an IRA for your health expenses, because it works pretty similarly in that you can invest the money and grow it over a really long period of time. So last is employee stock purchase programs. Now, again, if you are eligible for employee stock or stock options, please contact me after and I'm happy to walk you through them. They're pretty complicated and they're really different for every single employee. But what is the benefit of having an employee stock purchase program? Well, as an employee, you get to have a stake in the company. Remember, stocks you own. So you get to have a stake in the company, and that includes future earnings and dividends. It makes you feel like you're a bigger part of it. Also, often employee stock purchase programs can be offered at a discount. I've seen anywhere from 5 to a 15% discount. Also, you might have matching contributions from an employer. So again, not only if they are matching, that is free money. So you want to take advantage of that. Things to consider, however, is where do you think the company is going to be going? Do you think it's going to be doing well in the future? Consider diversification. So think back to our basket. Don't put all your eggs in one basket. Consider your bonus payments. Is employee stock part of your bonus payment? If so, well, maybe you don't want to be purchasing it on your own. And also consider blackout periods. So those are times where you cannot buy nor sell the employee stock purchase program, the employee stock. Stock options are a little bit different. As the name implies, it is the option to buy your employer's stock in the future. They give you a specific price, and that price is either called a strike or exercise price. So again, you're going to get the option to buy that in the future. Typically, they give you a time frame. So I've seen usually 1 to 4 years to exercise those options, but I have seen as long as 10 years. This is really important. Put in that time frame in your calendar, because once they expire, they're gone. You might think that, of course I'm not going to let that expire. We get busy, we forget. The moment you read your contract and you get some options, put those dates in the calendar to make sure you exercise the stock. What does exercising mean? That means that you said, yes, I do want to buy some of this company's stock at a specific price. You want to exercise when the stock price is quote unquote in the money. So this means that the company's stock is trading at a higher price than the strike price they gave you. So for example, if your strike price is $100 per share, being in the money would be when that stock is at $200 per share, right? Things to be really careful of with stock options is there's that the tax situation can be very complicated. Again, if you have them, this is definitely where you want to bring in an expert, both a financial advisor and a CPA, so that you understand your options and you understand the taxes you're going to owe, because sometimes, right, that you're going to owe. So that is it for me. And of course, we're going to open up to questions. I have plenty of time to answer them. I do have to say our team has grown since this photo, and we need to update it. I'm happy to say we also believe in diversity, and we have 2 men that have joined us, Xavier and Kevin. And there's our information. So please feel free to email me or call me, and I'm happy to help.
Awesome. Thank you, Maggie, for that wonderful presentation. So we've been monitoring the chat from the beginning.
Great.
And so I'm just going to kind of go in the order that I've gotten these questions. The first question is, somebody asked, are there any catches to the high yield savings accounts?
It's a great question. I get it all the time. No, there aren't. So people think that all the time, why am I getting a higher yield? The reason is there is no brick and mortar for those banks. So you're not going to see an Ally Bank on your street corner. Any savings that that the Ally Bank, for example, makes, that's how they're able to give you a higher interest rate. They pass it on to their clients. So that's, I guess, the only catch, right? If you need to walk into a bank, you're not going to be able to do that. Also, because there's not an Ally Bank or a Capital One 360 bank, you're not going to have an ATM that you can go and take the money out of. That being said, most of them will tell you, you can go to a CVS and use all of the CVS ATMs. Or they're going to tell you, you can have 15 withdrawals from any ATM you want a month and we'll reimburse you all the fees. So just read the fine print, but a lot of those reasons that you wouldn't use a high yield savings account, they've really addressed. The thing you want to look for is to make sure it's FDIC insured. That those 3 examples I gave you are. That means that every account owner is insured up to $250,000 if they've saved up to that much. So if the bank were to go under, the insurance from the government does pay you up to that amount based on your savings. So you shouldn't lose your savings if they're below that amount. Also, you want to make sure there's no account minimum and there's no fee associated, because there's plenty of banks out there that don't have a fee. So why pay them if you don't have to? And the last thing I would say is that it does take some time, usually 1 to 3 business days, to move money from your high yield savings into your checking account. I think that's a positive because frankly, that money is for savings. So it's going to make you think twice if you really need to move that money into your checking account.
Awesome. So next one is kind of about retirement planning. Are there any good tips to identify what kind of lifestyle we should expect to finance in retirement? Sometimes it can be hard to picture yourself in that age and know what kinds of things you'll want to spend on at that time.
Yes. So I would say definitely think about healthcare. We are living longer than ever due to phenomenal medical advances, which on the one hand is great, but on the other hand, we're living longer than ever and typically need more healthcare. So at the very least, you know that there's going to be a pretty big healthcare bill. In terms of envisioning what you want to do, I think that's going to become clear to you over the next decade or so. You're going to figure out what hobbies you like, and you're also going to figure out that your job probably doesn't let you do them. So I know in COVID, I've pursued a lot of my hobbies because I'm stuck at home. And so those are the sorts of things I know I'm going to want to do in retirement, right? So for me, it's skiing. I'm a really avid skier. And that's a really expensive sport. So I'm going to try to plan to be able to do more of that in retirement. But if you tend to be a homebody now, you're retired, you probably aren't going to change that in retirement, right? So maybe it won't be as expensive for you to retire. But if you love to travel now, you're probably going to do even more of that in retirement. I have to tell you, I work with a lot of retirees as well, and they're all busier than when they worked. They're finally getting to do all the things that they couldn't do because they had a full-time job.
Awesome. On to 401ks. What's a good employer match rate for 401k contributions?
You either will see a flat somewhere between 3 to 5%. I really haven't seen in many instances higher than 5. And they also might do kind of a graduated schedule, right? So we'll match 3% up to your 5%, right? Or we'll match 2% if you put in 3%. So I haven't really seen better than 5% though. And that brings up a good point I didn't bring up in the presentation. Be aware of vesting. So if you have a vesting schedule, that means that you need to be with the employer for X amount of years before you can take the entire match with you. So anything you put into your 401k is going to be 100% yours to move when you switch employers, but anything they put in might have a vesting schedule that says, oh, you have to be with us 4 years before you get to take with you the 100% match.
About kind of Roth IRA versus Roth 401k, kind of what is the difference? Are there any differences between the two?
Yeah, so I think I briefly touched upon them, so I won't go in too much, but a Roth, it's really when you pay taxes. So a Roth 401k or a Roth IRA, you're going to pay taxes now, and then the money's going to grow tax-free. With a traditional or non-Roth 401k or IRA, you're going to defer your taxes now, and you're going to pay them in retirement. The one thing to note, and again, I mentioned this in the presentation already, but not everyone is eligible for a Roth IRA simply because there is an income phase out there. But everyone is, regardless of income, eligible for a Roth 401k if your employer offers it.
But is there a difference between like a Roth IRA, like someone opens up individually versus a Roth 401k?
Thank you for the clarification. Okay, so overall, no, not from a tax perspective. And there's, as I mentioned, there's some additional rules that govern 401ks, Roth 401ks and Roth IRAs, which is it needs to be opened 5 years before you're able to take the money out. Also, you're actually, after it's been open for 5 years, you can actually take out what you put in. Not the investment piece, but you can take out what you put in before 59 and a half before suffering that 10% penalty. So those are kind of added bonuses, I would say. That's an added bonus. But in terms of the difference between them, the only difference is that there is an income cap for a Roth IRA and there is not an income cap for a Roth 401k.
Awesome. That's good to know. Is there any benefit or loss in a Roth IRA if I put if I put the $6,000 all at once versus, doing $500 each month over 12 months?
That's a really great question. Two schools of thought. I personally, especially when the market is volatile like it is right now, really like to do what I call dollar cost averaging in. So that's exactly the second piece, putting $500 in a month. Why? Well, because if the market's going up and down every single month, you're not going to be able to time it yourself when's the right time to invest. So by putting in the exact same amount every single month, you're inevitably going to buy low when the market's down. You're going to buy more shares, right? Because, if something's $10 a share and you're putting in $500, you're going to buy, a certain amount of it versus if it goes down to $5 a share, you're going to buy more of it with $500. So that's what we call dollar cost averaging. And you're going to get the most fair price over time. The other school of thought is, don't wait to invest. And if you have a big lump sum, throw it in and then dollar cost average. Again, if the market has kind of been steadily moving upwards, like we saw for the last 11 years, that might be a good option. But right now, I think that dollar cost averaging makes more sense.
Awesome. So kind of moving on to investing, how do you calculate your expected rate of return? Would it fluctuate over time? I think this is kind of referring to when you did those calculations.
So those calculations were from NYU Stern School of Business. And so I had just gotten them off the website. I did not calculate them myself, full disclosure. But in terms of how to think about your expected rate of return, there's no way to predict how something is going to perform, right? There's no guarantee in investments. The one place you might see a guaranteed rate of return is if you have something called a stable value in your 401k, and that's your employer has said, you're going to get 3% on this investment this year. But otherwise, you're not going to have a guaranteed rate of return. But you can look at statistics like the one I provided to understand, okay, large cap US stocks in the S&P 500 have on average returned, 9.5. Okay, but bonds have returned 3.5, and I have a healthy mix of both. I think my rate of return will be somewhere between that, right? And if you really want to get nitty gritty, I'm trying to avoid actually doing math right now on screen. But if you want to know more about that, just email me and I'm happy to tell you exactly how you could calculate it. But just be wary that just because it happened in the past doesn't mean it will be that way in the future.
Awesome. Someone asked for a recommendation. So is there a course or a series of courses over the summer that you would recommend a high school student to kind of enroll in to just like learn more about personal finance in the stock market?
So I don't actually know of a course, which is a shame. But one of the books I love is it's not. Let me get back to that one. I'm going to pull up the book in Google. I can't remember it off the top of my head, but it's like the best one that everyone always recommends to read.
I Will Teach You How to Be Rich.
Yes, that's it.
That's the book that I read, and I think a lot of people have also read to just get started. So I would also recommend that book. It's I Will Teach You How to Be Rich by Ramit Sethi.
Exactly. And I was actually lucky enough to see him speak when I was in high school, which was really cool. And that was kind of what motivated me to also go into personal finance. But it's really easy to read. It's really easy to comprehend. Again, I read it in high school, so it's perfect for a high schooler or anyone.
Absolutely. Okay, so FSA versus HSA questions. What is the difference between a higher and lower deductible health plan? Is an HSA to be used for just medical related costs, such as like surgical procedures and things like that?
So the first question was, what's the difference between a high deductible and low deductible? Okay, so I preface this with I'm not a healthcare professional or expert, but generally speaking, a high deductible plan will mean that there's a quota that you need to pay out of pocket. So first and foremost, both plans are going to have you pay something per month that's going to come out of every paycheck. So a high deductible plan's monthly amount typically is lower than like a PPO plan or a low deductible plan. All right. But then when you go to a doctor, you're going to have to pay that doctor out of your pocket. Or when you buy, healthcare or whatever, go into surgery, you're going to have to pay that out of your pocket. And the amount you pay gets put towards your deductible. So for some high deductible plans, the plan can be as high as $10,000 deductible. So what that says is you're going to have to pay $10,000 that year in medical expenses yourself before your insurance kicks in and starts paying for you. Some have lower plans though. Some have $4,000, $5,000. It really depends on the plan. The reason that this would be beneficial is this is for somebody that's genuinely like, I only go to the doctor once a year. I go for my physical, that's it. Why do I want to be paying $500 a month for insurance I'm not using? I'd rather pay $100, have this high deductible, and basically have insurance only if I get into like an accident, right? And then just be able to pay out of pocket $250 to see my doctor once a year. And the benefit is that you get to use that HSA account, which is tax deferred money, and you can grow it over time. Lower deductible or a PPO plan, you're going to pay a much higher amount per month. There typically will still be a deductible, but it will be $800 or $1,000, something that's much more likely for you to hit per year, especially if you see a doctor a lot. So like personally, I see a specialist once a month. And so I, have typically chosen a lower deductible plan because I know that I'd have to pay a lot out of pocket. The second question was, if you can only use the HSA or the FSA for health. Yes. So, but that definition is pretty broad, and you just have to look through your benefits to understand what it is. So it's not just, surgical procedures or seeing your doctor. It can be medicine. It can be contacts, physical therapy. I've seen chiropractors and therapists covered under it. I've even seen prescription sunglasses. So literally my husband got like designer sunglasses last year, prescription, he's blind as a bat, prescription, under his FSA. So the list is pretty extensive. So it is pretty worth it, to be honest.
Awesome. Can you have both a FSA and a HSA, or do you have to just pick one?
You can have both if they're both offered you for the most part, but again, check your benefits.
Okay. Regarding health insurance post-retirement, how much will that cost since we won't have employer-provided health insurance?
That's a tough question. Okay. It's definitely increasing. I can't recall the statistic off the top of my head, but it's going to be higher than it is now. That's for sure. The great thing is that when you're 65, everyone gets Medicare. So you're paying into Medicare every single time. You'll see it on your paycheck. It's FICA, F-I-C-A, FICA. That's going into Medicare. So that's part A. So the beauty is that you're going to get that. And to be honest, Medicare is a really great program. Like the costs are not very high associated with it. Then you do have to find some room for Medicare Part B, which is your prescription drug cover, which gives you some additional coverage. And then you also need your prescription drug coverage. I have an expert on my team. If you want to learn more, his name is Kevin Perro, who shops this around, knows all about this. Again, I'm not the expert, but generally speaking, Medicare is actually a pretty affordable plan, which is why you hear a lot of politicians now saying Medicare for all, because it's pretty affordable. That being said, it is income dependent. So if you've saved a lot and you have this beautiful nest egg in retirement, you're going to end up paying more than somebody who hasn't saved anything for retirement. The problem that I see is those that want to retire a little bit earlier. They've done a lot of work. They sold their business. They're ready to retire at 57 or 59 or 60, and then you have a pretty substantial gap. And the only options are to enroll into the Affordable Care Act, the exchange, and that is pretty costly right now, especially if you're in a higher income tax bracket.
Okay. Awesome. So one more question. If you have a plan for investing for retirement, so 401k, etc., are mutual funds and ETFs is still still a good suggestion for investing your short-term savings, such as like buying real estate. So I'm guessing this is like, should you invest in mutual funds or ETFs, even for like your individual investment account?
Yeah, so it's going to depend on how much work you want to do. So buying individual stocks in general, especially if you're not well versed in investing, is particularly risky. So if that's something you want to do to learn or to play around, just make sure that that's money you're okay losing. And I don't mean that to be negative. It's just, make sure it's not money that you need in the future. Otherwise, if you're more savvy of an investor, that's your call to make. The way I think about it is I use an analogy with medicine. So if I'm ill and I have a headache, I might start with Googling my symptoms. And if I get my answer from WebMD, maybe it's just to take some Tylenol, great. But if I am more sick than that, I am not going to use WebMD to try to manage my symptoms. First, I might go into a walk-in clinic because that's convenient. I'll meet a doctor that I'll probably never see again. They'll give me Z-Pak for my sinus infection. I'll get better and I'll be on my way. I kind of think of that as robo-advisor. You probably aren't going to have a relationship with a financial advisor, but you're still going to get the cure or the answer you need. I think of WebMD as kind of managing it on your own, managing stocks and bonds on your own. And then the last is when you have a relationship with your primary care physician or maybe a specialist. That's what I think about a financial advisor. It's somebody that you're talking to ongoing, that you're seeing regularly. They know your medical history. Same thing with a financial advisor. So to kind of answer your question, I think it's going to depend on your comfort level and how much time you want to spend on it. But if you don't want to spend on it, but you do understand that you want to be growing your wealth to buy real estate, for example, then starting with a robo-advisor or even contacting a financial advisor. I know, Kavya, you mentioned my Next Gen subscription service. It's $100 a month and you get some access to me and help with investing. That's something to consider. And then to really answer the question, mutual funds and ETFs are a really great way to get diversification and have an expert really be managing those investments for you. So even if you are doing it on your own, I think a mutual fund or an ETF is going to be a more diversified and less risky approach, of course, depending on what you invest in, than trying to buy stocks and bonds on your own.
Awesome. Just because we're kind of like over time and in the interest of your time and everyone else's time, I'm just going to share our contact information to kind of wrap up the event. But if there are any more specific questions, the team will stay behind. Maggie, if you do have a few minutes and if you don't mind staying back, please do. If not, I'm about to share her contact information so that you guys can reach out to her. But yeah, thank you all for coming. So this is, again, Maggie. So her email is maggie@johndrowwealth.com. Is that the best way to reach out to you, Maggie? What else would you like to share?
Best way is definitely email maggie@johndrowwealth.com. And then again, if you want to follow us on social media platforms, we're at Johndrow Wealth. So pretty easy. 2 W's.
Yeah, we'll also send out that information in the post-event email, so stay tuned for that. So Young Not Broke, our website is youngnotbroke.co, and that's where you can find all of our information. We have a ton of blog posts, stories that we share about recent graduates and things like that, and also all of our future events. So if you sign up for a newsletter, which is on that website, you will get all the updates straight into your inbox. And then you can also follow us on Instagram at Young Not Broke. We also do a couple of Instagram lives from time to time, which is also a fun way to interact with us. So thank you again, Maggie, for your time today. This was a wonderful event, and thank you for all of your advice. Thank you for everyone who attended. We really appreciate you guys showing up today. So feel free to stay back. And if you have any questions, we'll stick around for a few minutes. So thank you, everyone.
Thanks. That was great, guys.
Thanks
Thank you.
for coming, guys. Let's see if we have some specific questions. I know we had one that was, what is your advice on money markets for a young novice investor?
Yeah, I mean, most money markets, are kind of in the same range. A high yield savings account I typically see does better right now than even a money market. So it's a good place to park your cash as you're waiting to invest it, but I don't think it's a good long-term place. I would probably just go with a high yield savings account.
Okay. And then if you're an intern and you have, I think health insurance, I think this is what they're asking. Like if you're an intern and you're getting health insurance, does that affect your pay? Feel free to clarify if I asked your question incorrectly.
So if you're an intern and they're giving you health insurance, I think maybe the question is, will I get less money because they're giving me health insurance? Yeah. Maybe. I mean, benefits in general are part of your entire compensation package. So when you get your compensation package, it might say your total compensation is $100,000, but really like 40,000 of it is like employer match and 401k, insurance, et cetera. So it might not be your take home salary. So I think that's what the question was.
Okay, awesome. What website would you recommend for calculating risk tolerance for investing?
So if you go to my website, particularly, we have a tool on it that says check your risk. And the tool is called Riskalyze. And it's really neat. You basically put in the amount of money that you have invested or plan to have invested, and it will ask you 5 questions that build upon each other to really understand your risk tolerance. It's a really cool program. It will basically say, like, you have $10,000 to invest. Like, how would you feel if you opened your account in 6 months and saw that 5,000 of it was gone, right? Or how would you feel if you saw you had an extra 10, right? So it's a really interactive program. So that's the best I've seen. And I'm not just saying it because it's on my website. I researched a lot of them and that's the one I chose. So
okay. Awesome. We will link to that in the post-event email. Cool. I also know that if you do sign up for like a robo-advisor or something, they have like a survey that you fill out before it starts investing your money. So that's another way to do it if you are going down that route. When would you prefer stock options to restricted stock units?
I don't know if you get a choice. So I don't know if it's a preference necessarily either. Like, I think most places I see kind of give you both or give you either or. I don't know if there's necessarily, there's different tax consequences, but again, I wouldn't say one is like a preference or better than the other, right? If you really think that the stock is gonna go up in value a lot, then obviously having the option to buy it at a much cheaper price and then sell it at a higher price can make you a significant amount of money. But there's taxes that are owed on that, right? And there's a lot of rules around it, like you're not allowed to sell those for a full year or sometimes 2 years. I think RSUs have a little bit less rules around them as to where you can sell, but they still do too. So I wouldn't say it's a preference. And I think usually you get options of both anyway. So, again, that's something you want to talk about specifically with a professional, truly.
Awesome. If your short-term savings has grown past 10K, would you recommend just storing that in a high yield savings account for about 5 years, or is investing in general a smarter choice?
So that's a personal question for everybody. So I would recommend that you fill out your budget and figure out exactly what your needs are every month. And that doesn't include getting your nails done. That's my favorite thing to do. And it does not include that. It's literally food, rent, utilities, student loan payments. Figure out what that number is per month and multiply it by 3, and then also multiply that number by 6. So if that number is $5,000, right? If your 3 months is $5,000, then yeah, you could take the other 5 and probably put that into an investment account, right? If you know that you're not going to need that in the next 3 to 5 years or longer. If that number is 10 grand, then that whole thing should be your emergency fund and go into the high yield savings account. If that money is above 10 grand, then definitely put the 10 grand in a high yield savings account and then continue saving your emergency fund before you're investing.
Awesome. So we didn't really touch on student loans today, but somebody has a question. What's your advice for paying back a large amount of student loans? Is it worth putting money towards investing, or should you put any and all money not needed for loan repayment?
Great question. Could literally be its own webinar. We could talk about it offline if we want to do that sometime, but student loans are tricky. So first and foremost, if you are in a nonprofit, you do have the nonprofit student loan forgiveness program. And that is a very tricky program because the provisions are very specific in how you pay off those loans. And a lot of people have become negative on it. I know there's a lot of articles in the news where people thought they would get the forgiveness and they weren't. But I have actually first-handedly had clients that did get the forgiveness. But again, it's because we really mapped out what you have to do. So you have to be at a nonprofit that qualifies, right? So first you have to go to the website and check. You also have to be making very specific payments. They can't be early, they can't be late. They have to be on time the day they're due, and you should not be making additional payments because those will not count towards the loan. So if that is your case, then you should not be making any additional payments if you're trying to qualify for the public student loan forgiveness program. If that's not the case and you're in corporate, well then and you expect to be in corporate forever, then I would suggest looking at your loan, seeing if you can consolidate it and refinance it for a better interest payment. That's first and foremost. Second, then I would look at how much do you expect to get in the stock market over time versus how much do you think, versus your interest on your student loans. So last year, the market, the S&P 500 returned almost 30%. So I did not think it was smart for my clients to take money that they had growing at, call it 30%. I mean, it depends on how you're invested, but let's say their money grew at 30%. And to take that money to pay down a loan that was costing them 3%. So, but on the flip side, if your loan is 16% and you're only making a 1% on your investment, then yeah, you should be making additional payments. So I think I guess the takeaway here is that how are you using that excess money? Are you spending it on expensive clothing? No, put it towards your loan. But are you saving it and being really mindful about it and investing it? That could make sense because listen, we all want to pay down our student loans, but it is good debt. In fact, we didn't talk about it today, but it can really help your credit score as long as you're making timely payments. You know, it's debt to get you a higher paying job. You know, it stinks that many of us, myself included, had to take them out. But, you know, on the flip side, kind of be proud that you put yourself through school and you're bettering yourself. But that doesn't mean that you shouldn't also create wealth for yourself just because you have student loans. So it's probably somewhere in between for most people.
Awesome. Thank you for that answer. We're actually doing an event in 2 weeks that's on student loans with student financial services from a university. So they will have all the advice about student loans, whether those like are federal, private, and everything in between. So stay tuned for that. Awesome. So it looks like we have no more questions, and just because we are at 6:20 and I want to respect everyone's time, we are going to end the event right now. Thank you all again. Just stay tuned for that post-event email. You're going to have a recording, a survey that you can fill out to let us know how you thought about this event, and all of the contact info for Maggie and for us. So thank you all so much for coming, and thank you, Maggie, for your time again.
Thank you so much. I really appreciate it.
All right. Bye, everyone.
Bye.